Hello, this is Barbara Fowler, and this is Chapter 1 of International Business. We're going to talk about globalization today. Globalization is the shift towards a more integrated and interdependent world economy. The world is really moving away from self-contained national economies towards an integrated global economic system. The globalization of markets refers to the merging of historically distinct and separate national markets into one huge global marketplace. It no longer makes sense to talk about the German market or the American market. Instead, there is a global market. Falling trade barriers make it easier to sell globally. Consumers' tastes and preferences are converging on some global norm, and firms promote the trend by offering the same basic products worldwide. It's important to recognize that significant differences still exist among national markets, requiring companies to customize market strategies, product features, and operating practices to meet the conditions in particular markets. The globalization of production refers to the sourcing of goods and services from locations around the globe to take advantage of national differences in the cost and quality of factors of production, such as labor, energy, land, and capital. By doing this, companies hope that they can lower their overall cost structure and improve the quality or the functionality of their product offering, thereby allowing them to compete more effectively. Early outsourcing efforts were primarily confined to manufacturing enterprises, but today, more companies like Vizio, if you remember that was in our chapter Management Focus, and they sell flat panel TVs. They're taking advantage of modern communication technology like the internet to outsource service activities to low-cost producers in other nations. There are still substantial impediments to the globalization of production, including formal and informal barriers to trade, barriers to foreign direct investment, transportation costs, issues associated with economic risk, and issues associated with political risk. Now, what type of product currently has a stronger global market? Most global markets currently are not markets for consumer products, where national differences in taste and preferences are still more important and are enough to act as a brake on globalization. But markets for industrial goods and materials that serve a universal need the world over are incredibly large. These include markets for commodities such as aluminum, oil, and wheat, the markets for industrial products such as microprocessors, computer memory chips, commercial jet aircraft, markets for computer software, and the markets for financial assets from U.S. Treasury bonds to Euro bonds to futures in the Nikkei index or the Mexican peso. Global institutions help manage, regulate, and police the global marketplace and promote the establishment of multinational treaties to govern the global business system. The World Trade Organization, like its predecessor, GATT, polices the world's trading systems, making sure that nation-states adhere to the rules laid down in trade treaties. It promotes lower trade barriers and investment barriers, and the World Trade Organization has 154 members in 2011. If you click on the World Trade Organization logo, you can watch a video clip by Susan George on the functions of the World Trade Organization, World Bank, and the International Monetary Fund. The United Nations was established in 1945. It maintains international peace and security, develops friendly relationships among nations, cooperates in solving international problems and promoting respect for human rights, and it is a center for harmonizing the actions of nations. The G20 is a forum through which major nations try to launch a coordinated policy response to the 2008-2009 global financial crisis. So these are all global institutions that help with world trade. What is driving globalization? International trade occurs when a firm exports goods or services to consumers in another country. After World War II, advanced industrial nations of the West committed themselves to removing barriers to the free flow of goods, services, and capital between nations. And if you look at the slide that we're talking about right now, look at the difference between the trade barriers and the tariffs in 1913 and 2010. You can see in the U.S. they went from over 45% down to an average of 3%. So the average tariff worldwide now is just 4%. What is driving globalization? Foreign direct investment occurs when a firm invests resources in business activities outside its home country. Declining barriers create more favorable environment for FDI, and in 2009, the global stock of FDI was 15.5 trillion. Lower barriers to trade and investment mean firms can view the world rather than a single country as their market. They can base production in the optimal location for that activity. But firms may also find their home markets under attack by foreign firms. So it's a two-way street. A U.S. firm can go to another country and lower the costs, but a firm from another country can come here. Managers today operate in an environment that offers more opportunities, but is also more complex and competitive than that of a generation ago. What globalization means for firms. First, there have been lower transportation costs, which help create global markets and allow firms to disperse production to economical, geographically separate locations. The low-cost information processing and communication, so firms can create and manage globally dispersed production. Low-cost global communications networks help create an electronic global marketplace. And these global communication networks and global media create a worldwide culture and a global consumer product market. So as we hear more from other countries and other cultures, then there's things that we want in common. Major advances in communication and information processing have lowered the cost of global communication and therefore the cost of coordinating and controlling a global organization. The Internet has had a tremendous impact. It's grown from virtually zero in 1998 to nearly 165 billion in 2010. And there's also transportation technology. The most important developments are probably the development of the commercial jet aircraft, the super freighters, and the introduction of containerization, which greatly simplifies shipment from around the world. There have been drastic changes in the demographics of the world economy in the last 30 years. 4 trends are important: the changing world output and world trade picture, the changing foreign direct investment picture, the changing nature of the multinational enterprise, and the changing world order. In the 1960s, the U.S. dominated the world economy and the world trade picture. U.S. multinationals dominated the international business scene and accounted for over 40% of world economic activity. By 2009, the U.S. accounted for just 24%, and a similar trend occurred in other developed countries in Europe and Southeast Asia. In contrast, the share of world output accounted for by developing nations is rising and expected to account for more than 60% of world economic activity by 2020. A good example is the growth of the India software sector over the last 25 years. 4 factors accounted for the growth of the sector. First, the country has a large supply of engineers. Second, labor costs in India are low. Third, since many Indians are fluent in English, coordination between Western firms and Indian firms is easier. And fourth, because of time differences, Indians can work while Americans sleep. How has foreign direct investment changed over time? In the 60s, U.S. firms accounted for about 2/3 of worldwide FDI flows. Today, the U.S. accounts for less than 1/5. Other developed nations have followed a similar pattern. In contrast, the share of FDI accounted for by developing countries has risen. Developing countries, especially China, have also become popular destinations for FDI. What is a multinational enterprise? A multinational enterprise is any business that has productive activities in 2 or more countries. We see growth of new multinational enterprises from the world's developing nations, and we also see the growth of mini multinationals. These are small and medium-sized companies, and they also are going global. So you'll see even average-sized companies that are in your local community thinking about selling or importing business or activities globally. Many former communist nations in Europe and Asia are now committed to democratic politics and free market economies, creating new opportunities for international business. However, there are signs of growing unrest and totalitarian tendencies in some of these countries, so this might become less over time. China and Latin America are also moving toward greater free market reforms. The global economic outlook it's moving towards a more global economic system, but globalization is not inevitable. There are really signs of retreat from liberal economic ideology in Russia and other countries. Globalization brings risk, such as the financial crisis that swept through Southeast Asia in the late 1990s, and the recent financial crisis that started in the U.S. in 2007 and 2008, and then moved around the world. So there has been increased globalization, but also people are looking at it a little bit more closely. Supporters believe that increased trade and cross-border investment mean lower prices for goods and services, greater economic growth, higher consumer income, and more jobs. So a supporter would see that if the U.S. no longer manufactured flat-screen TVs because it was cheaper in China, they would see this as a positive. There would be an initial loss of jobs here in the U.S., but because they're so much cheaper produced in China, when they come back to the U.S., many more consumers can buy them. Additionally, because the Chinese are now making more money and going more into the middle class, they can afford to buy more goods and services from the U.S. So that's what supporters say. Critics worry that globalization will cause job losses, environmental degradation, the cultural imperialism of global media. So they worry about some of the different things. And critics also argue that firms avoid the cost of adhering to labor and other legal restrictions when they go abroad. How does the global marketplace affect managers? Managing in an international business differs from managing a domestic business because countries are different and there are many cultural differences. The range of problems confronted in an international business is wider, and the problems more complex than those in a domestic business. And firms have to find ways to work within the limits imposed by governmental intervention in the international trade and investment system. International transactions also involve converting money into different currencies. So it is more complex. And as we go through our international business course, we're going to learn many more things about the opportunities and the challenges of going global. Thank you very much.